This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. My guest today is Alex Chompff, and Alex is an early stage venture capitalist specializing in pre-seed companies. Alex, welcome to the show.
Gabe, thank you very much for the invitation to be here. It's an honor.
Alex, venture capital is the wild west of capitalism. Tell us a little bit more. How did you get swept up in this? And maybe take a step back and say, what is venture capital?
Okay. All right. Good question. Venture capital is a class of private equity. Your audience is probably familiar with public equities. So usually we see things like the NASDAQ or the Dow Jones or the S&P 500. Those are public equities. Those are things that any investor can get involved in, usually through a pretty simple trading platform, right? Could be E-Trade or Robinhood or anything like that. Their counterpart is private equity. Private equity are companies that are not typically available to the public. And inside of private equity, you have a whole set of possible investment types. And the early stage professional investing is called venture capital investing. And typically what we're doing is we're taking capital and we're taking a risk on new ventures. Depending on the investment firm and their appetite for risk, they might invest anywhere along the startup journey from you've got a couple of startup founders and they've got a bright idea, or maybe they've got a product, or maybe they've got revenue, or maybe they've got real traction, or maybe they're ready to expand and grow. Pretty much, anywhere inside of your first probably $20 million in annual recurring revenue, maybe $40 million in annual recurring revenue, you're probably talking to a VC if you're talking to somebody who's investing private capital for equity returns or equity stakes.
Got it. So if I understand correctly, you take money from your investors and you invest that money on their behalf in new companies, new startups that have a promising future with maybe some kind of a really nice paycheck 5-10 years down the line.
That's exactly what we do. That's precisely what we do. Yes. And, for anybody out there in the startup world that might be looking for venture capital investing, it might be comforting to know that we VCs have to look for our own investors too. So even though we're writing checks to you guys, we're collecting checks just like you are. Okay. So, everybody has somebody that they're looking to have work with them. How did I get into it? Through luck, really. I was born in California, and I was raised in Northern California, as I mentioned, in Concord, California, which is where I met my wife after I came out of the military. And it was 1995, and the Economist magazine said that they were making millionaires in Silicon Valley. And I showed this to my wife, and I said, hey, we didn't actually, we were 23, 24 years old. We didn't know where Silicon Valley was. It turned out to be one bridge and 45 minutes away. So when we figured that out, we went there right away. After enjoying a few different positions, I was lucky enough to be recruited to become the director of technology for a firm called Kleiner Perkins Caulfield and Byers. So I was contracted in as their director of technology. And, for your audience who hasn't heard of KP, they're pretty well known for some pretty major investments over the years. They were certainly famous long before I got there, and they were famous long after I left. But I did have the opportunity to serve as their director of technology through the dot-com boom. And I also was fortunate enough to be able to do the same thing for Integral Capital Partners and a few other firms. And so that really gave me a solid basis in venture capital and understanding venture capital. My father was an entrepreneur and had invented his first product while I was in high school. So I had the entrepreneurial bug early. My family is very entrepreneurial. They're all immigrants and they all worked very hard to give their kids a leg up. And so we really got that entrepreneurial bug. And then once I understood how capital flow worked, that was even more intriguing to me. And subsequently, my wife and I decided to go have kids. And after we had our fifth child, and that one was out of diapers, she said it would be okay for me to go back and play in this world again. And so that's where I find myself. Really, it's I can't help myself. I love being around brilliant people. I love being part of what's new and exciting. And it's very rewarding and fun to put capital to work on great ideas and for great teams.
One of the things that fascinates me about venture capital in general is you have to evaluate companies and ideas, right? So I imagine you get all kinds of businesses being pitched to you on a regular basis saying, Alex, we got this great new idea, or hey, look, we have this company. Like you said, it's two or three friends that got together and we have a product. How do you evaluate an idea? Because I know that in general, it's very difficult to predict winners, especially in the venture capital space. No one has a crystal ball that says, yeah, this company is going to be huge 5 years from now versus it's not going to be successful. But how do you personally evaluate these ideas and companies?
Yeah, that's a really good question. And there's a fairly long answer, which you can get to on our website in the form of a class that we offer for free to anybody who's interested. Um, but the sort of general answer is it's all about risk management. And there's this kind of counterintuitive thing that happens in very early stage investing. It's really interesting. The earlier you are investing, the more perfect the information is that you have available to you. You got to think about that for a minute. It's very counterintuitive.
It is counterintuitive. Yeah.
Very counterintuitive. But the earlier you are investing in a company, the more possible it is to understand and know all of the components of that company. When I'm talking to two people at a kitchen table, I know everything about the company. I can know those two people. I can know everything about their idea. I can understand what they have in mind. I can be certain that all of the things that they're thinking are going to change, right? The old saying, no plan survives contact with the enemy intact, right? And reality changes everything. But it is possible, and interestingly possible, to actually have relatively perfect information the earlier you get to the startup moment in a startup's life cycle. What's unknown are all the risks that are out there in the future, right? Will the market like this? Will it be sold at a profitable level? Will it be sold at sufficient scale to create an enterprise that has the kind of value that's necessary to create the returns that are appropriate for venture capital? Venture capital needs very, very outsized returns because we have very, very high failure rates. So that means that every investment that we make has to be capable of carrying the entire portfolio in case everything else goes down the tubes, right?
Oh,
So,
say that again slow. I think that was important. So maybe tell us how many
this is
different
very
businesses,
interesting. Yeah.
yeah, how
Yeah.
many
When you
different
compare it
businesses
to
do
other
you,
asset classes, right? Like public equities, the odds of your public equity portfolio trending to zero are very low. If you have a real estate portfolio, the odds of your real estate portfolio trending to zero are very low. If you have a startup portfolio, the odds of your portfolio trending to zero are shockingly high. Okay. There's a lot of math and science out there that shows that most companies fail.
Mhm.
Okay. And by the way, let's talk about this for a minute. Venture capital is a particular kind of investment. It's not suitable for all classes of business. Probably more than 90%, I would guess. This is just my guess. I'm going to say more than 90% or maybe even 95% of the businesses out there never seek outside capital. They get the money from their founders or from a bank that loans it to them. Or maybe two or three founders get together and put their money into a restaurant, or they put their money to a brick and mortar institution, or even an online institution. But generally speaking, new companies do not go out and seek investment, particularly from professionals, because that's what a venture capitalist is. A venture capitalist is a professional who's managing other people's money, often at relatively high cost to the person that's investing the money. And so they need to be distributing that money into places that are going to have outsized returns that overcome the tendency of the portfolio to trend towards zero. So there's a very small percentage of companies that even conceivably qualify. Once you get over that hump of a project that conceivably qualifies, then there are a number of things that I think everybody looks for, like the quality of the team, the size of the opportunity, the relative maturity of the product, the, acceptance of the market to that product. The earlier you are in a company's life cycle, the less you know about these things. And so the better the valuations tend to be. As you move along and you develop that product, well, something has been de-risked. As somebody buys that product, there's another de-risking point. As 10, 15, 100, 1,000 people buy that product, the product continues to be de-risked. Now, other risks come into play. Can the company grow successfully? Can the company manage debt? Can the company manage human resources? Can the company manage regulatory problems? Right? So there's a different set of risks that come up later, but they come up typically with the presence of revenue. And revenue is, it's like a fresh coat of paint. It hides a multitude of sins. So the further you get down the revenue road, typically the less risky you're seen as being, until eventually you get to some point, let's call it 30, 40, $50 million a year, where you're really not seen as all that risky anymore. You're really seen as an ongoing concern. And then a different slice of private equity typically gets involved and offers you financing if that's what you're looking for at that stage.
And you hit up on the risk profile of these startups. What is the investment horizon? How many years do you typically, wait until you get your money back? What is your typical investment horizon look like?
The standard investment horizon for any venture capital firm in the United States today, by default, is going to be 10 years. And typically there's an option to extend that on the part of the general partners of the fund by another year or two if necessary. So you could be looking at 10 to 12 years in the earliest stages of investment. It is interesting because the longer it takes a company to pay out, the more likely that the payout will be substantial. And there's a very fine line there in the 5, 6, 7, 8, 9 year mark, where you're hoping to get some liquidity on these assets before your fund runs out. And then you have to go through a different set of gymnastics.
So tell me a little bit more about when you talk to your investors, how do you prepare your investors so that they understand the risk reward profile and the time horizons involved with the investment?
Good question. Well, first of all, you have to understand that in order to invest in venture capital or a venture capital firm like the one that I manage, you have to meet a certain SEC threshold, which is known as being an accredited investor. Okay, so startup investing is available to non-accredited investors in different ways, but in terms of pattern and scale, it's pretty much limited to accredited investors. Accredited investors are people who have certain income levels or certain wealth levels. And so typically now what we're talking about is we're talking about a percentage of their portfolio. No responsible individual would encourage you to put a oversized amount of your portfolio into assets that could trend to zero, right? They would say, well, be conservative in how much you invest there. So, sort of magic numbers that you'll see in this field might be 5%, or if you have a very high appetite for risk, it might be 10%. But probably no responsible manager would encourage you to go much above that. And so then the idea is that with that small percentage of your portfolio, can you create outsized returns by taking advantage of this longer time horizon? And what's interesting here is this mathematical concept called a power law curve. And a power law essentially says that if you take enough startups and you distribute them on a graph, most of them will come in very early in terms of the value, meaning a very relatively low value. But some of them will come in later on the graph in what's called this kind of long tail or fat tail. And those returns can be really quite amazing. Mathematically, the earliest stage of investing, by which we mean companies that have taken in less than $5 million in total investment, based on the most recent data science available from the data scientist at, I think it's Carta, is that the returns tend to trend toward infinity.
That sounds pretty amazing, Alex.
As long as you understand that most of them will fail. Most of them will return to you less than you put in, or not enough, either zero or half or 1.2 times what you put in. And that's not very satisfying after 5, 6, 7, 8 years when, let's say 50% of your portfolio is going to go to zero. But if you have a large enough portfolio, a diverse enough portfolio, the mathematics support the idea that at least a couple of those companies will perform so well that they will more than make up for the entire shortfall of the rest of the portfolio. And I think, the a reasonable expectation in my mind for the returns that would warrant the risk in a relatively segmented section of my portfolio, I would probably like to see 50% or better returns than I might see in a public equities portfolio. Right? So if the internal rate of return is, let's say, 50% or better than it might have been by investing in purely public equities, then I think that's a reasonable case to be made. Now, it can exceed that. And, as a class, venture capital does tend to do reasonably well, particularly when you consider emerging managers and when you consider the earliest stages of investing. Once you get past about $5 million invested, then the end of that tail no longer heads toward infinity. It tends to come down and touch the x-axis, and the returns become bounded. They can still be quite sizable, but they tend to become bounded. And that's because these companies have presumably used that money to remove those risks associated with the market, with scaling, et cetera.
Tell us a little bit more about the typical investor who invests with your funds, and how many different companies you have right now in your fund.
Sure. Well, what we are finding today is that particularly real estate investors or people who have made their money in public equities are looking for an opportunity to access a class of assets that's normally not available to them. So even if you do qualify as an accredited investor and you want to take the time to find the investment opportunities in your area, and you want to take the time to go through looking at all those opportunities and sussing out which ones are the best, you're really probably not going to perform as well as you would like without broad diversification. So that's to say, you generally want to index across a year, for example. And unless you live in the heart of Silicon Valley and you are very deeply involved in the startup scene, you're probably not going to see enough businesses come by in the river for you to be able to select a broadly diversified portfolio, negotiate terms, et cetera. That's where a firm like ours becomes very handy. So with a firm like ours, you could say put $50,000 or $100,000 into a venture capital firm. And to answer your second question, which is our frequency of investment, we invest at a rate of about once a week.
Wow, that's incredible. How selective are you, Alex? Between all the different business ideas that come down the pipeline, what is your selection? What am I trying to say? The selection rate, like how many of them do you turn away versus invest in?
Sure. Let me finish the earlier thought, which is to say, if you wanted to invest $50,000 or $100,000 into this class, it would be very, very difficult for you to get exposure to 50 companies in a year on your own.
Right.
Especially at $2,000 a company. Right. They don't really want your $2,000, and you don't want to go through that much work for $2,000. So this gives you an opportunity to get diversification and access through a team and a network that's been built over many, many years, so that we have access to those kinds of flows. Okay, now ask your question again.
Yeah, I was going to ask, how selective are you with all the different business ideas that come across your desk?
We're quite selective. We're quite selective. We invest hours and several different people's worth of brain function before we make investments, and we turn down many more than we accept. So even though a small percentage of the companies in the world ever seek this kind of investment, an even smaller percentage actually receive that investment. And the general industry standard is about 5% of those companies that seek investment will typically receive it. We tend to take a somewhat broader look than that. Our numbers tend to be a little bit higher. Now, they say private equity is private, so I'm not going to give you all of our internal numbers, but we do tend to be a little bit more permissive because we are very, very early stage investors. We are often the first or second investor on a cap table. We're usually the first professional investor on your cap table, and we're really betting on the team 80% of the way. And because of the function that I mentioned to you earlier, where it's actually possible at very early stages to have relatively perfect information, just speaking in generalities, we tend to bet on people and we tend to be pretty optimistic about humans.
Tell me a little bit more about your philosophy and outlook on technology. Maybe in particular, let's start with AI. Some people say AI is just getting started. Some people say it's a bubble. What is your personal thesis and outlook on AI?
Mm. Well, I'll start by offering the central tenet of my investing philosophy, which I've developed over many, many years. And the central tenet of my investing philosophy is that technology decomposes monolithic industries. Technology decomposes monolithic industries. Okay, so there's a couple of interesting things going on there. Number one, monolithic industries tend to have a lot of money in them. That's why they're monolithic. Technology tends to kind of sidle up alongside these monolithic industries and through specialization start to pull away revenue that's already in existence, that's already occurring. So this differentiates us from some of our other competitors because venture capitals, like any other market, we compete. Okay. So sometimes people are looking for market makers or market creators. Sometimes people are looking for, purely disruptive or purely new science or purely new material or purely new medicine. That's not what we're looking for. We're not unwilling to take a look at those things. But generally, what we're more interested in is you explaining to us how you're going to take some of the billions of dollars that are already flowing around in the industry that you're somewhat of an expert in, that you've developed a kind of technology solution for, that decomposes some aspect of that industry and brings that revenue to you. Because not only do we find that that is a virtuous thing, we think revenue is much more virtuous than investment. So if you want to tell me that you've raised $10 million, I'm going to be much less impressed than if you tell me that you've earned $10 million. Right? That takes us to the second part of my thesis, which is run to revenue. So we're looking for companies that, in general, are decomposing monolithic industries. Now, how does that apply to AI? Well, AI is multifaceted. AI has burst into the public consciousness within the last year or two, particularly in the form of large language models. But the idea of machine learning has become more or less ubiquitous throughout industry, especially the technology industry. So to that end, we are happy to invest in companies that understand and ride that trend. So I'll give you an example. We recently invested in a company that came out of Santa Clara University that goes by the name Fuel AI. Fuel AI.
Like fuel, like Fuel.
Fuel AI, right? And Fuel AI is led by a brilliant CEO who had a very simple realization after having been in the AI industry for years. Okay, machine learning and AI industry for years. So remember, we're looking for that kind of monolithic industry, right? And what she said, her name is Virginia Puccio, she said, listen, the number one problem that all of these companies are going to have is high quality training data that's both proprietary and verified. And as we have just recently learned in the press in the last 3 or 4 weeks, if you feed synthetic data to AI, LLMs, you break them. Mm. Synthetic data breaks LLMs. So you can't have your AIs feeding your AIs. That doesn't work. You have to have large pools of fresh, new organic data. So Virginia Puccio set about recruiting people around the world who were willing to work to create data sets about anything that somebody might be interested in. And she has, I think the last email I read was, I might be a little bit high, but I want to say 10,000 bounty hunters around the world that are essentially doing a kind of TaskRabbit function where they're providing high quality, original, verified data to people who want to train their models. So let's say, this is a real world example, let's say you're a company that wants to automate roof inspection by drones. It's a fantastic example. It has nothing to do with language, but it has everything to do with learning and machine learning. Well, where are you going to get 50,000 pictures of roofs that are high quality, that are in a particular part of the country, that are taken at a particular time of day from a particular angle? You can't just go and get that information from Google. That's a unique data set. So you go to Fuel AI. Fuel AI puts bounty hunters to work, and bang, here comes the information that you need to train your people. So now we have a number of interesting things going on here. We have technology, right? We have decomposition. We have another one of my most favorite theses, which is innovation is better than invention. I prefer innovation over invention, right?
And maybe how do you differentiate between the two?
Well, invention is hard. That's the easiest thing to understand. Innovation is when you're solving problems with the tools that are already around you. So I'll use an example. Amazon. So Amazon's a good example because my client was an initial Amazon investor back in those days. So that was fun. I got a chance to be there when that company had just gone public, and there was a lot of fun things happening. In any case, Amazon was interesting because Amazon was not the first online shopping center. Amazon was not the first one to do e-commerce. They were innovating, not inventing. They were doing things better. And by the way, what Amazon decomposed through technology was not shopping, but logistics. Amazon decomposed logistics because 25 or 30 years ago, if you wanted to be in the logistics business, you had to have a truck. You had to have a manifest. You had to have a radio. You had to have a dispatcher. There were all kinds of things you needed if you wanted to be in logistics. Now you can do it on a unicycle with your phone, an hour at a time. You only need one wheel and a phone, and you can be in logistics. Just like 25 or 30 years ago, if you wanted to be in the public influence or entertainment industry, you needed to have access to studios, producers, distribution centers, all kinds of things. Now you need social media. So technology decomposed entertainment, technology decomposed logistics. There are many examples of technology decomposing monolithic industries. It's been my observation that this happens frequently. So I look for companies that are doing that. I look for companies that are innovating before they're inventing. I look for companies that are running to revenue, because all of those things are the kinds of things that build a portfolio of companies that other people want to buy, because I have to return money to my investors in a limited amount of time. And principally, that's going to be through the exit or sale of the companies that I've invested in.
Now, we talked about AI. Are there any other technologies that you personally are very excited about? Any technologies that you think can solve big societal or global problems in the next 5 or 10 years?
I think there are too many for me to reasonably be able to list. I would say that artificial intelligence is interesting because, in my estimation, and I'll use a parallel from my own life. In 1995, when I came home from the military, every single shopping center had at least one travel agent in it. Some had two travel agents. Right? You remember that?
I remember that, yeah.
You go talk to the nice lady and tell her what you want to do. And she would turn to the machine, and 15, 20 minutes later, she would give you three choices, and you could pick A, B, or C. And right, well, okay, where are the travel agents of today? They're gone. Okay, they're gone. There are some around, but they had to find very, very specialized niches, and most of them are gone. And I think that you're seeing something similar happen, for example, in the real estate market. Right? Technology is absolutely disrupting real estate. Technology is disrupting banking, finance, right? These things are being disrupted. Artificial intelligence, by which most people mean ChatGPT or large learning models, like just kind of sticking to that narrow genre, I would imagine that most attorneys are situated similarly to travel agents. Right? In 1995, that was a good job. you had a good beat on your life, you had a high quality of life. I think that if I was an attorney, I would be very concerned about large language models.
Yeah, and I can tell you from my own experience, you can say to ChatGPT or Google's Gemini, you can say, hey, draft me an operating agreement for my new LLC and this and that, and it will give you a reasonably good draft. Now, it's still a draft, and of course, you still need to take it to an attorney to have a second look over, but you're not starting from scratch, and it definitely takes a lot of the initial steps and the guesswork out of it.
Well, and this is just really the first publicly available generation of this kind of technology, right? So there's lots more specialization coming. I think anybody who does what attorneys do, which is interpret large bodies of texts to find intersections and present those intersections for advantage or, competitor disadvantage. I think that all of those areas are very subject to disruption by this large language model. I've used ChatGPT for everything like you have, from drafting legal agreements to technical support problems. And it does just a fantastic job of sorting through a lot of things very, very quickly. I would be cautious about using it for anything that is not very, very verifiable and very well documented.
Tell us your thoughts on ethical capitalism. That's a phrase I saw on your website, and it sounds like it's something very close to your heart. Tell us more.
Oh, yeah, absolutely. Well, let me start by saying that I do genuinely believe that capitalism, by which I mean the Dutch understanding of shared risk and shared reward. Okay, so for those of your listeners who may not be familiar, this idea of corporations and shareholders and owning a piece of the pie or somebody else's risk. You put up the capital, they do the work. There's some return for you. This is a Dutch idea. The heart of the Dutch Empire was on this idea, right? But that principle that you can organize people by giving them a common interest, common risk, and common reward, I think is one of the most, if not the most powerful organizing principle that I'm familiar with for the common benefit. I think there are very, very few things that yield greater results, greater benefit than to have people working in concert to produce something that is considered to be valuable and that in turn sustains the individuals who have the idea, do the work, put up the capital. Very, very big believer in capitalism. I do think, however, that capitalism is a human invention. Corporations are a human invention. These are societal constructs that we allow to persist because they're of benefit to us as a society. And so I think it's very, very important then that we as a society manage the creatures that we create so that they perform in ways that are beneficial for us on balance. Unbridled capitalism has some ugly sides to it. I'm not a big fan of unbridled capitalism. Now, I'd rather have people operate using their moral compass that they're born with. Every person is born with a moral compass. I'd rather have people operate with a moral compass so as to practice capitalism in an ethical way than have that imposed by the government, for example, through somebody else's version of what's ethical or not ethical. What I would like to see over time is I would like to see a better distribution of returns across a wider population. One of the things that we talk about a great deal, and that's really become obvious through the data science of the last 20 years, is that returns are disproportionate in the structure. The relative minority of the people participating enjoy the relative majority of the gains involved. And I would like to see, not through taxation and redistribution, not through top-down government intervention, but through an understanding that we all take into our hearts and that we carry forward as operators and propagators and users of this tool called capitalism. And understanding that a broader distribution of the outcome or the benefit inures to a society that's filled with people who feel ownership. I think people are much, much less likely to break windows when they feel like they own the place. And I think a lot of the window breaking that we've seen in these past few years arises from a sense that it's not your place anymore. You don't own the place anymore. And I think that's just completely wrong. I think however you got to this country, doesn't matter to me whether you were born here, you flew here, you swam here. I don't really care. When you got here, you were issued a metaphorical backpack. And in that metaphorical backpack, there's a tool called capitalism. And you may not be familiar with that tool. You may not know how to use it, but it is yours to use and it's available to all of us. And it's no more complicated than deciding with a friend or on your own that you're going to create something that you own that provides a value or a benefit to society, and that in turn creates what you need for yourself: security, choices, perhaps even wealth. So that's what I mean by ethical capitalism, is the use of a tool for the benefit of the people, because wouldn't exist without us. Corporations are a figment of our collective imagination. Let's make sure that the tools that we create are benefiting us, not harming us.
I agree with you 100%. I think it's important that as a society, we try to include everyone in the progress, in the prosperity. Alex, how does this philosophy come through in your investment philosophy?
Well, it comes through in many ways. Let me start by saying that everybody in our firm and in our associated firms begins with a profound sense of gratitude, a deep appreciation for the combination of luck and circumstance that have set us upon the road where we are in a position to be able to do things like help other entrepreneurs through the investment of capital or the sharing of community or the inculcation of culture. So we are profoundly grateful to be in this position. And from that position of profound gratitude, then our question is how can we serve you? How may we be of service to you? Because I do happen to believe that every human being is a spark of the divine, and that the most laudable thing that I can do before I leave this earth is figure out how to serve the divine by serving the people that are the instantiation of the divine. And that idea permeates throughout our work. So that can be everything from not hoarding information, right? Not withholding information that can be to the advantage of a counterparty, to not withholding or generally widely opening up our network to help the people that come to us in one way or another, whether or not we have any financial benefit that we're going to receive. Right? Ethical capitalism starts with understanding that you have resources, and those resources are for the common good. So whether or not you stand to financially benefit, it's incumbent upon you to use your network, your knowledge, your resources that you've been blessed with to help the people around you. That's probably the first and most important instantiation. There are a few others, like I tend to favor patterns around equity distribution that are more European than American. So if you're familiar with European equity distributions, they tend to be considerably chunkier. They tend to be considerably broader. You tend to have ratios of compensation that are, let's say, the bottom of the compensation ladder is within 15 or 20 multiples of the top of the compensation ladder. Where in the United States, it's not uncommon to see the bottom of the compensation ladder on average be 200 or more positions away from the top of the compensation ladder. So I tend to like distributions that reflect the value of people. Not that the top of the organization doesn't deserve to receive rewards that are commensurate with the risk that they're putting into the organization. But I would rather see a company organize itself in such a way as to more equitably distribute the profits that are realized through the hard work of the entire team.
Alex, if somebody wants to reach out to you to learn more about your company, to maybe even invest with you, what is the best way to learn more and to reach out?
Come to our website, evfm.co, evolutionventuresfundmanagement.co. Come on in. We're very easy to find. I'm very easy to find. We run an open door policy. We say hello to everyone. We get back to every person. And we encourage you to come and learn. We're here to help aspiring entrepreneurs and to help aspiring investors. We're here to help people get access to a tool that is otherwise unavailable to them in private equity, and where, there are significant benefits to participating in this world. So we really want people to have access to this world. We don't gatekeep. So come and let us help you. That would be what I would say.
Sounds great. I will put those links into the show notes. Alex Chompff, thank you very much for taking the time to speak with us today.
Gabe, it's been an honor to be here. Thank you so much.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.